Hello everyone, welcome to Chapter 12, Intermediate Accounting. So we're going to learn about the various approaches used to account for investments that companies make in the debt and equity of other companies. So to finance its operations and often the expansion of those operations, a corporation raises funds by selling equity securities, which can be common or preferred stock, and debt securities, which may be bonds and notes. Now, these securities are also called financial instruments, and they're purchased as investments by individual investors, mutual funds, and also by other corporations. Our focus in this chapter is on the corporations that invest in debt and equity securities issued by other corporations, as well as debt securities issued by governmental units, bonds, treasury bills, and treasury bonds. Most companies invest in financial instruments issued by other companies. Some investments are made simply to earn a return from the dividends or interest the security pay, or from increases in the market price of the securities. The same reasons that may motivate you to buy stocks, bonds, or other investment securities. Other investments represent ongoing affiliations with the companies whose securities are acquired. With such diversity in investment objectives, it's not surprising that there's a diversity in the approaches used to account for these investments. Have you ever bought a CD, certificate of deposit, at a bank? If so, you've invested in a debt instrument. Let's say you buy a $500 2-year 4% CD. What's happened is that you're lending the bank $500 for 2 years, and the bank is promising to pay you 4% interest each year before returning your $500 after 2 years. Now, the bank's debt, which is the $500 borrowed from you, is represented by a debt instrument, which is the CD, which specifies the maturity date, which is 2 years, the principal or face amount, which is $500, and the annual rate of interest, which is 4%. Now, companies invest in debt too. So like a CD, a bond, or other debt security, it has a specified date when it matures. And on that maturity date, the principal, which we could also call the face amount, is paid to investors. In the meantime, interest equal to some stated interest rate multiplied by the principal is paid to investors on specified interest dates, which are usually twice a year. Think of the principal and interest payments of the bond as a stream of cash flows that an investor will receive in the future in exchange for purchasing the bond today. The investor values that stream of future cash flows using the prevailing market interest rate for debt of similar risk and maturity at the time the investor purchases the bonds. So here we're going to talk about United. Here it shows United's going to pay Masterware $666,633 on July 1st of 2018. In return, United expects to receive from Masterware $42,000 every 6 months for the next 3 years, in addition to the face amount of $700,000 when the bonds mature on June 30th, 2021. The $666,633 that United pays is the present value of future cash flows that United expects to receive, discounted at the prevailing market rate for bonds of similar risk and maturity. Now, of course, if United sells the bonds to another investor, that investor will receive the remaining payments of interest and principal. To determine the issue price of the bonds, it's important to understand how investors compare the bond's stated rate with the market rate. If the interest rate paid on the bond, which is the stated rate, is higher than the market rate, investors are willing to purchase the bond for more than its maturity value. So in that respect, it gets sold at a premium. But if the bond's stated rate is lower than the market rate, then investors are willing to purchase the bond only at an amount less than its maturity value, so it's sold at a discount. In this slide, Masterware was offering its bonds for 12%, but investors could have obtained bonds of similar risk and maturity at a more favorable, higher rate of 14%. So to attract investors, Masterware has to sell the bonds at a discount. So when debt instruments or investments are purchased, they're recorded at cost, which is the total amount paid for the investment, including any brokerage fees. We see that United paid $666,633 to purchase Masterware's $700,000 bonds. United debits investment in bonds for the face amount and credits cash for the price paid for the bonds. Because United purchased the bonds for an amount that's less than their face amount, it credits discount on bond investment for the difference. The discount on bond investment is a contra asset to the investment account that serves to reduce the carrying value of the investment to its cost at the date of purchase. Now, if United instead had purchased the bonds for an amount, let's just say $725,000, that's higher than the face amount of the bond, which was $700,000, it would instead debit premium on bond investment for $25,000 to record the investment at its cost at the date of purchase. So let's look at a question. Chan Inc. purchased bonds for $800,000 that have a maturity value of $900,000. Chan's journal entry to record the purchase would include A debit of $100,000 to discount on bond investment, B, a credit of $100,000 to discount on bond investment, C, a debit of $100,000 to premium on bond investment, or D, credit of $100,000 to premium on bond investment. As you see here, the correct answer is B. The bond investment is debited at $900,000, cash is credited at $800,000, and then we have a discount on the bond investment for $100,000. So Masterware's bonds have a stated rate of 12% payable semi-annually. This means every 6 months United will receive exactly $42,000 in cash from Masterware. However, recall that United purchased the $700,000 bonds at a discounted amount of $666,633. Why would United pay less than the $700,000 face value for the bonds? And why was Masterware willing to sell the bonds for less than $700,000? At the time United purchased the bonds, the market rate of interest for bonds of similar risk was 14%. So United would only be willing to invest in these bonds if it could earn the 14% it could get elsewhere, not the 12% stated rate. To earn the higher rate, United needed to pay only $666,633. Paying the lower amount means United lowered its investment cost and effectively increased its rate of return to 14%. While United will receive $42,000, 6% in interest from Masterware in the first 6 months, it will effectively earn interest revenue of $46,664, which is 7% on the investment. The amount by which interest revenue exceeds interest received, which is the $46,664 minus the $42,000, is $4,664 in the first 6 months. It represents a piece of the cost savings from purchasing the investment at a discount. This piece of the cost savings increases United's investment return from the rate the bond pays, which is 12%, to the higher rate of 14% that investors could have earned on other similar bonds at the time they purchased the bond. In fact, this approach is called the effective interest method because Interest revenue is based on the effective interest rate that the investment earns over its lifetime. So the journal entry to record the interest received for the first 6 months as investment revenue is to debit cash for the stated rate multiplied by the face amount, in this case $42,000. Debit the difference of $4,664 to the discount on bond investment account. Now this entry reduces the discount from $33,367 down to $28,703. Because the discount gets smaller, the amortized cost of the investment, equal to $700,000 less the discount, gets larger by the same amount, from $666,633 to $671,297. Then credit interest revenue for the market rate multiplied by the outstanding balance. Here's the amortizations table that would be used for the masterware bond. It shows interest being recorded at the effective rate over the life of the investment. The amortization of discount gradually increases the carrying value of the investment until the investment reaches its face amount of $700,000 at the time when the debt matures. If the bonds were instead purchased at a premium, a similar amortization schedule would reduce the premium over time until the bond's amortized cost reached the face amount of $700,000, which is the amount to be received when the debt matures. So accounting for changes in fair value depends on the classification of the debt investment. As shown in this slide, debt investments are classified in one of 3 categories: held-to-maturity securities, trading securities, and available for sale securities. So the key difference among the reporting approaches is how we account for unrealized holding gains and losses, the critical event number 3 shown on the slide. Regardless of the investment type, investors can elect the fair value option that we'll discuss later in the chapter and classify HTM, the held-to-maturity securities, and AFS, which is the available for sale securities, as TS, which would be the trading securities. So this slide provides a description from a recent annual report of how the Bank of America accounts for its debt investments in each of the 3 reporting categories. Why treat unrealized gains and losses differently depending on the type of investment? Well, as you know, the primary purpose of accounting is to provide information useful for making decisions. What's most relevant for that purpose is not necessarily the same for each investment a company might make. For example, a company might invest in corporate bonds to provide a steady return until the bonds mature, in which case day-to-day changes in market value may not be viewed as very relevant. So the held-to-maturity approach could be preferable. But on the other hand, a company might invest in the same bonds because it plans to sell them at a profit in the near future, in which case the day-to-day changes in market value could be viewed as very relevant, and the trading security or available for sale approach may be preferable. So let's take a look at exercise 12.1. Ladio Vaugh Corporation acquired as a long-term investment $258 million of 5% bonds dated July 1st, on July 1st of year 1. The company management has the positive intent and ability to hold the bonds until maturity. The market interest rate was 12% for bonds of similar risk and maturity. Ladio Vaugh paid $215 million for the bonds. The company will receive interest semi-annually on June 30th and December 31st. As a result of changing market conditions, the fair value of the bonds at December 31st, year 1, was $218 million. So we're going to prepare the journal entries to record Ladio Vaugh's investment in the bonds. First thing we're going to do here is we're going to debit the investment in bonds for $258 million. Now we're going to credit our cash for $218 $215 million, which is what we paid for the bonds. And the difference is what we call the discount on the bond investment. The discount's the contra asset to the investment in the bond's asset account. It serves to reduce the carrying value of the bond asset to its cost at the date of purchase. Now we'll prepare the journal entry by Lady of Vogue to record interest on December 31st of year 1 at the effective market rate. The cash, $258,000 times 2.5%, remember this is for 6 months, is $6.45 million. The investment revenue is the $215,000, what we paid, times 6%, or $12.85 million. The difference will be the amortization based on the discount of the bond investment of $6.4 million. At what amount will Lady of Vogue report its investment in the December 31st year 1 balance sheet? Well, we're going to show a debit to investment in bonds for the $258. A discount on the bond investment will be $43 million. And with this particular journal entry, we will debit this discount to $6.45 million to come up with a new balance in the discount on bond investment for $36.55 million. Then suppose Moody's bond rating agency downgraded the risk rating of the bonds, motivating Tanner to sell the investment on January 2nd, year 2 for $191 million. Prepare the journal entry to record that sale. So as you see here, the cash of $191 million is what is being received here, $191. The discount on the bond investment, we need to zero that out. The investment in bonds, $258 million. Therefore, we're going to have a loss on the sale of this investment for $30.45 million. Now, let's take a look at exercise 12-2. Wells Corporation acquired as a long-term investment $440 million of 8% bonds dated July 1st on July 1, year 1. Company management has the positive intent and ability to hold the bonds until maturity. The market interest rate was 5% for bonds of similar risk and maturity. Wells paid $500 million for the bonds. The company will receive interest semi-annually on June 30th and December 31st. As a result of changing market conditions, the fair value of the bonds at December 31st, year 1 was $480 million. Our job, to prepare the journal entry to record Wells' investment in the bonds on July 1st, year 1, and then the journal entry by Wells to record the interest. And at what amount will Wells report its investment in the December 31st, year 1 balance sheet? And then suppose the bond rating upgraded the risk rating of the bonds and Wells decided to sell it for $520 million. We will then prepare the journal entry. So to show the investment in the bonds, it acquired it for $440 million. The cash amount in the bonds is $500 million. Therefore, we paid a premium on these bonds of $60 million. Now for interest, we will show that cash, $440 million times 4%, which is half of a year, $17.60 million. Our interest revenue is going to show the $500 million times 2.5%. And then the difference will be our premium on the bond of 5.4%. At what amount will Wells report its investment on December 31st of year 1? Well, we'll have an investment in the bonds in addition to the premium on the bond investment for a total of $494.9 million. Suppose KP Bond Rating upgraded the risk rating of the bonds and they decided to sell. Well, if we sell it for $520, we're going to debit our cash. Then we're going to have to credit our premium on the bond investment. We'll credit our investment in the bonds, and in this case, show a gain from the sale of the investment to $25.10 million. Next, let's look at one more problem, exercise 12.6. So Hills Corporation acquired as a long-term investment $65 million of 8% bonds dated July 1st. On July 1 of year 1, company management has the positive intent and ability to hold the bonds until maturity. The market interest rate was 6% for bonds of similar risk and maturity. Hills paid $68 million for the bonds. The company will receive interest semi-annually on June 30th and December 31st. As a result of changing market conditions, the fair value of the bonds at December 31, year 1, was $66 million. So our job, prepare the journal entry to record Hills' investment, and then to record the interest. What will it show on the balance sheet? And then what do we do if they sell it? The bond rating upgraded the risk, and Hills decided to sell the investment for $70 million. So the first step, the journal entry will be a debit to investment in bonds. The cash is for $68 million, and we have a premium here on the bonds for $3 million. Then, for recording the interest, we're going to debit our cash for $2.6 million, credit our interest revenue for $2.04 million, and the difference will be a premium on the bond investment. How will it be reported as of December 31st of year 1? Well, we'll show the $65 million bond plus the premium less how much we've already amortized it to be in the balance sheet, $67.44 million. The fair value adjustment would be the 66 less the 67.44 million, which would show here a loss of 1.44 million. So we're going to show here our unrealized holding loss of 1.44 and our fair value adjustment here, a credit of 1.44. What if the bond rating agency upgraded the risk? Well, our fair value adjustment balance on July 1st is a minus 1.44. And what is needed to update it to fair value? Well, the balance needed on 1/2 of year 2 is the 70 million minus the 67.44, or the 2.56 million. So basically what we'll do is we'll show the change that is needed, the 4 million that is needed in order to create this new value. So as you see here, the fair value adjustment for the trading security investment, 4 million, and we have an unrealized holding gain of 4 million. Suppose KP Bonds Rating Agency upgraded the risk rating of the bonds, and Hills decided to sell the investment on January 2nd, year 2 for $70 million. prepare the journal entry. So we'll show cash of 70, credit our investment in bonds. We'll also credit the fair value adjustment, and we'll credit the premium on the bond investment of $2.44 million. Again, because we're treating these as trading securities, we treat it at fair value. Now we're going to take a break here and move on to the next lecture.